the interest rate derivatives topic is a mighty big can of worms. And once you open it, it's very difficult to get it back into the same can. Because the numbers involved are measured in hundreds of trillions. So, and most people don't really understand the true nature of how these things are used by officialdom to effectively control the yield curve. You see, it used to be, back when I got into institutional markets back in the 1980s, there was a group of people known as the bond vigilantes. Well, the bond vigilantes are like dodo birds. They're all dead. They don't exist anymore, and the last of them probably died, I'm going to say, 20 years ago. And they died coincidentally at the same time, I'm going to say, round about the time when Glass-Steagall was repealed in 1998, which allowed the investment banks to become major players in the derivatives, the OTC derivatives markets, and turned our entire capital markets edifice into a casino. And the unshackling of banks, and I mean, it was a multifaceted approach that was used, because what officialdom came to understand through the 1990s is that they could control the entire yield curve, basically rendering the bond vigilantes impotent. And they are impotent because there is no, as people believe, when interest rates are forced to zero, people believe it's a flight to quality. That's the way it's been dubbed by officialdom. They attach these monikers which try to explain away the inexplainable. And having interest rates at zero with the degree of money printing that's going on is something that doesn't compute. Like, the sun doesn't shine when you have thunder and lightning storms. And to say that in the face of record issuance and ridiculous record issuance of debt by U.S. government, to think that rates are at zero is sort of like me telling you that the sun's shining when the sky's black and we have lightning bolts and thunderclaps going on all around us. They're not simpatico. So what it's all about is that when we give numbers, I'm just going to recite some numbers here. Total derivatives aggregate outstanding held by American financial institutions at the end of Q4 in 2019 was $228 trillion. That sounds like a pretty impressively big number. I want you to understand that over 80% of that aggregate amount involves interest rate contracts. So the derivatives complex is heavily skewed towards interest rate contracts. And with these interest rate contracts, especially when officialdom gets involved, they tend to be on one side of the trade where they, in swap terms, they receive fixed. They synthetically lend, okay? Which is another way of saying they synthetically create demand for U.S. government debt, transaction demand for U.S. government debt, whether it's a 3-year bond, a 5-year bond, or a 10-year bond, or a 6-month, 3-month, or 1-year T-bill. They have the ability to make banks captive buyers of U.S. government debt in any amount they choose to do. So I gave you the number of total outstanding aggregate derivatives at the end of 2019. So now let's move forward to the first quarter of 2020, when the effects of this alleged pandemic were beginning to be felt in our global markets. The yield on the 10-year bond in the first quarter of 2020 fell from 1.80 to 60 basis points. So it was cut to a third of what it was 3 months earlier. Well, guess what happened to the total amount of derivatives aggregate outstanding from 228 trillion at the end of Q4 in 19 to the end of Q1? That amount had swelled to 267 trillion. So we saw a very, very sizable bloat in the outstanding aggregates, and that embodies the increase in transaction demand that was created by officialdom by being receivers of fixed in the swap market and by selling FRAs at the short end of the market at rates under T-bills. If I sell you an FRA for 6-month LIBOR under T-bills, you're going to do that trade all day long because you can lock in instant profit and it's no risk to you. And the reason for that is LIBOR is always going to be higher than T-bills. So, and anyway, this bloat from 228 up to 267 trillion in 3 months created unbelievable trillions of dollars of demand for U.S. government debt.
So let me understand. We got like $40 trillion in one quarter added to this transaction demand. In the aggregates. And then what happened either because of that or simultaneous with that is driving down the 10-year Treasury bond from 1.8 to 0.6.
Because the banks were made risk-free captive buyers of U.S. government debt, meaning they couldn't lose on the trade.
Nice job if you can get it.
Yeah, well, you see, this is why, Dunnigan, let's first off say that, these big numbers I'm giving you, 98% of the action is held by 5 institutions. Okay, and those 5 institutions are JP Morgan, Citibank, Goldman Sachs, Morgan Stanley, and Bank of America. So those 5 institutions run books, derivatives books, anywhere from, say, 40 up to 53 or 4 trillion currently. And that is the lion, and I mean the massive lion's share of all this. And these guys have been running books this size or bigger for 20 years. And not one of them has ever got it wrong. You see, if you get it wrong when you have a $50 trillion book, you go bankrupt very quickly because you eviscerate your regulatory capital. I mean, if you're offside by 1% on a $50 trillion position, your capital's gone as a bank. And how is it that these banks have never got it wrong? Have you ever traded and never had a bad trade?
I wish.
You see, I worked in these markets back in the 80s. And my biggest client was the biggest client in the world at the time in derivatives. Citibank Canada Toronto. That's where these interest rate derivatives were birthed, is here in Canada. Citibank Toronto was the biggest player in the world. They were the clearinghouse for Citibank worldwide, and Citibank was the biggest institution in this trade for over a decade through the 80s and 90s. And when the people in New York figured out how powerful these instruments were, and in fact that they could be used to control the yield curve, that's when the Citibank Canada Toronto derivatives book was repatriated back to New York in the early 90s. Because that power wasn't going to be allowed to rest anywhere other than New York, where the Fed and the U.S. Treasury had a hands-on involvement. The guys who ran the book at Citibank back in the 80s, who I knew very well, became friends of mine, spent a lot of time with them. These guys these guys got it. But let me tell you something. Because I knew them and had intimate contact with them, they had losing days. They had losing months. A losing day or a losing month today could be the end of a financial institution if we had free markets. The reason they never fail is because on the other side of the bulk of their trades is the Exchange Stabilization Fund, a dark adjunct of the U.S. Treasury. When the Exchange Stabilization Fund engages you to be a payer of fixed, they're telling you right up front that they're synthetic lenders, okay? And they're telling you that you can engage in a huge trade where you have no risk, but they're giving you an absolute guarantee that rates are going down. And then, of course, doing what banks do best, they front run that because they have intimate knowledge that the ESF is going to force rates down. That's why they're never on the wrong side of this. That's why they've never slipped up. And that's why banks haven't gone bankrupt wholesale all over the place. The fact that these banks can run books this size for 20 plus years, and not one of them has ever had a major blow up and lost $1 trillion is absolutely stupefying to me.